Welcome to vTalkInsight, Market Drivers Daily for April 8th, 2026. A two-week ceasefire between the United States and Iran has flipped the macro script, sending oil into its steepest decline in years, while global equities and bond markets rapidly reprice the path for central banks. Let's unpack how this fragile truce is reshaping geopolitical risk, supply chains, and the evolving policy pivot. The dominant macro storyline today is the sudden shift from full-scale energy shock to fragile relief after a two-week ceasefire between the United States and Iran. Headlines around a temporary reopening of the Strait of Hormuz and assurances of safe passage have driven one of the sharpest single-day oil price drops since the pandemic, with Brent and U.S. crude falling well over 10%, and in some cases closer to the mid-teens. That collapse in the risk premium has unleashed an aggressive risk on move-across assets, with European equity benchmarks opening up around 5%, S&P futures gaining roughly the high twos, and travel and airline stocks sharply reversing prior war-related losses as jet fuel fears ease. The flip side of this relief rally is a brutal rotation within commodities and related equities. Energy stocks that had benefited from prior supply fears, including major European oil names and U.S. energy producers, are now underperforming sharply as the market prices out a worst-case scenario for infrastructure damage and sustained outages. At the same time, sectors that are sensitive to lower energy and lower yields, such as European airlines, parts of consumer travel, and higher beta cyclicals, are seeing outsized moves higher as freight and fuel assumptions are revised down from the extremes of recent weeks. This mirrors a broader cross-asset repositioning, with commodity exposures tilting away from oil and toward other segments as investors reassess which shocks are likely to prove temporary versus structural. Even with today's oil sell-off, the medium-term picture still points to a tighter and more fragile energy system than before the conflict. Physical prices for crude and products recently traded at extreme levels, with some regional benchmarks well above $140 and refined products like diesel and jet fuel clearing over $200 in Asia, and those earlier spikes have already erased prior surpluses and drawn down inventories. Production losses, including around a 6% hit to global output for a major producer in the first quarter, plus lingering damage to Gulf infrastructure, suggest that any return to normal is unlikely to mean a return to pre-crisis pricing, with several scenarios pointing to Brent stabilizing in the high 80s or low 90s rather than the 70s. Demand destruction is already visible in Asia, where roughly 1 million barrels per day have been cut, particularly in jet fuel, but the full impact on Western inflation and growth is expected to arrive with a lag over the coming months. Crucially, the ceasefire itself is widely described as fragile and highly conditional, which limits how much geopolitical risk premium can truly be removed. Iran retains significant leverage over the Strait of Hormuz, with reports of over 800 vessels still awaiting passage, military coordination required for transit, and even discussion of variable tolls that in some cases reach into the low millions per ship, all of which keep shipping and insurance uncertainty elevated. Key issues around Iran's missile and nuclear programs, its proposed 10-point plan, and sovereignty claims over Hormuz remain unresolved and in many cases unacceptable to the United States and its allies, while proxy activity and isolated drone and missile strikes continue to test the boundaries of the truce. That combination of a violent relief rally with unresolved structural and political tensions means risk assets are now highly sensitive to every headline on tanker flows, negotiations in Islamabad, and new tariff threats around countries supplying Iran, which will set the tone before we turn to the slower-moving, but equally important, supply chain story. Behind the dramatic price action, the real economy picture still looks constrained, particularly along the energy and shipping arteries that run through the Strait of Hormuz. Even after the ceasefire announcement, reports indicate that over 800 vessels, including more than 400 tankers and numerous liquefied gas carriers, remain stranded or highly cautious about transiting the Gulf because insurance cover is limited and ship owners are reluctant to be first movers. Transit is technically open, but Iran's military oversight, requirements for coordination, and in some cases variable tolls that can reach around $2 million per vessel have turned what used to be a routine passage into a high-friction, high-cost corridor. These logistics frictions mean that the physical market remains far tighter than headline futures prices suggest. Physical grades, such as dated Brent and Dubai, have traded far above front-month futures, with earlier spikes well past $140 or even $160 per barrel, and that dislocation has fed through into product markets where diesel, jet fuel, and petrochemical feedstocks in Asia have printed well over $200 per barrel. Asian refiners in China, Korea, India, and Singapore are facing acute crude shortages because disrupted Gulf flows cannot be easily replaced, forcing rationing, flight cancellations, and outright demand destruction of around 1 million barrels per day, particularly in jet fuel and some petrochemical chains. The knock-on effect is a rolling supply chain shock in fertilizers, plastics, and industrial chemicals, even as fertilizer equities and other input producers sell off today on expectations that the war premium will fade. The timing of these disruptions matters for macro and for earnings. There is an estimated 2 to 3 month lag before the full impact of higher Asian product prices and demand rationing transmits into Western economies, which implies that the West could feel tighter supply and higher input costs from May into the summer, even if today's ceasefire holds. That lag raises the risk of a second wave of inflation pressure in areas like transportation, packaging, and agriculture at the same time that some airlines and logistics firms are trying to pass on higher fuel costs to consumers through fees and surcharges. It also complicates growth forecasts, as international institutions are already preparing to trim global projections on the back of a negative supply shock, particularly for energy importing regions in Asia and Europe. One important nuance is that not all supply chains are behaving the same way. Despite the Middle East conflict and the disruptions around Hormuz, semiconductor and AI-related hardware supply chains have not been materially derailed, and the broader artificial intelligence capital expenditure cycle remains intact according to recent commentary, providing a partial offset to weakness in more energy-intensive sectors. That divergence suggests the shock is more about fuels, chemicals, and freight than about core technology components, which helps explain why chip stocks and AI-exposed names are rebounding strongly today, even as other industrials remain more constrained. From a risk perspective, the key watch points now are how quickly tanker backlogs clear, how insurers reprice coverage as safe passage is demonstrated or challenged, and what guidance we get from upcoming energy outlooks and speeches in Washington on the expected duration of these bottlenecks, which in turn feeds directly into the policy debate. The violent reversal in energy prices is already echoing through global rate markets, where the narrative is shifting back toward disinflation and renewed easing hopes after weeks of pricing in a more persistent inflation shock. Front-end government bond yields in the United States, the United Kingdom, and Germany are dropping sharply, with U.S. 2-year yields down several basis points, and even larger moves in gilts and bunds as traders pare back the likelihood of additional hikes. In the euro area, German 2-year yields are reported more than 20 basis points lower, and Italian 10-year bond yields have fallen by over 30 basis points, effectively unwinding earlier fears of a more hawkish European central bank path. This repricing has also helped pull U.S. Treasury yields down the curve, reinforcing the idea that the immediate inflationary impulse from energy is fading and bringing rate cut discussions back into focus. On the disinflation side, the combination of falling oil and gas prices with earlier signs of cooling in shelter and wages is giving central banks some breathing room. Recent data point to softer housing-related components and moderating wage growth, while today's historic plunge in crude natural gas prices is easing headline inflation expectations and supporting a rally in bonds. Markets are again entertaining scenarios of 1 or 2 Federal Reserve cuts later this year, consistent with some bank research that places base case moves around September and year-end, while long-term inflation expectations remain broadly anchored. In parallel, central banks in select emerging markets, such as in Central Europe, are already in or approaching easing cycles, and Hungary in particular is cited as having room for more pronounced rate reductions as risks become more idiosyncratic rather than systemic. The shift lower in yields is driving a rapid rotation across equities and credit. Yield-sensitive sectors in Europe, including real estate and utilities, are catching a bid as lower discount rates support valuations, while a renewed tech-led rally is visible in both U.S. and global indices as falling yields boost equity multiples and support forecasts for benchmarks like the S&P 500. Energy importing markets are outperforming, with indices such as the DAX, the FTSE 100, and Spain's IBEX all posting strong gains as lower input cost expectations filter into earnings assumptions. Emerging market assets are also benefiting from an easier dollar backdrop and improved global financial conditions, though the fragile nature of the ceasefire means that risk premia can widen again quickly if energy or geopolitical news flow deteriorates. Against this supportive backdrop, several caveats keep the policy pivot highly conditional. Some central bank watchers still expect elevated energy prices and ongoing supply disruptions to keep inflation pressures uncomfortably high in coming months, reinforcing the case for extended pauses rather than aggressive easing, especially if upcoming consumer price index prints reveal more pass-through via transportation and manufacturing costs. Markets have already scaled back from expectations of multiple cuts to a more modest profile of one or two moves, and there's a risk that policymakers either respond too slowly to the disinflation pulse or ease prematurely into what turns out to be only a temporary drop in energy prices. Key watch points now include Euro area producer prices and retail sales, the next U.S. inflation releases, and central bank communication from the Federal Reserve, the European Central Bank, and the Bank of England, all of which will determine whether today's rate rally evolves into a sustained easing cycle or remains a sharp but fleeting repricing. To pull this together, a fragile 2-week ceasefire has triggered a powerful relief rally, with oil prices plunging, risk assets surging, and bond markets swinging back toward a disinflation and rate cut narrative. Yet physical constraints in energy and shipping, especially around the Strait of Hormuz, keep medium-term supply and inflation risks alive, while central banks are navigating between easing headline pressures today and the possibility of renewed price stress as earlier shocks filter through. Watching tanker flows, insurance pricing, and the next round of inflation and activity data will be critical for judging whether this pivot toward easier financial conditions can endure. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.